Hi everyone. I think I am live everywhere now. Sorry for the delay. Um, I was running a little behind this afternoon. I almost said this morning. So I want to welcome you all here to our live stream on strategic financial planning. If you could all take a moment and comment on the video, whether you're on replay or live, talk about what your mission is, introduce yourself. My name is Katie Brailsford. I'm the president and CEO of KB Accounting. I have my MBA with a concentration in accounting and over 13 years experience in corporate accounting, specifically mission-based corporate accounting. So let's jump right in. What is strategic planning? And what's its significance? Strategic planning is a comprehensive process that involves analyzing an organization's financial situation, setting long-term financial goals, and developing strategies to achieve those goals in alignment with the organization's overall mission and objectives. It goes beyond the traditional financial planning by considering not only short-term financial needs, but also the broader strategic direction of the organization. Strategic planning is essential for several reasons. It ensures that financial goals are directly tied to the organization's overarching mission, vision, and strategic priorities. This alignment helps focus financial resources on activities that contribute most effectively to the organization's success. By carefully planning and allocating financial resources, strategic financial planning helps organizations optimize the use of their funds. It also allows them to prioritize investments in areas that offer the greatest potential for growth and profitability, while minimizing unnecessary expenses. Strategic financial planning also involves assessing and mitigating financial risks, such as market volatility, economic downturns, or unexpected expenses. By identifying potential risks in advance and developing contingency plans, organizations can better navigate uncertain conditions and protect their financial stability. A well-developed strategic financial plan serves as a roadmap for decision-making across all levels of the organization. It provides clear guidelines and criteria for evaluating investment opportunities, expansion initiatives, and resource allocation decisions, empowering leaders to make informed choices that support long-term sustainability. Stakeholders, including investors, donors, lenders, board members, they all often require assurance that the organization has a sound financial strategy in place. Strategic financial planning demonstrates fiscal responsibility and accountability, instilling confidence in stakeholders and fostering stronger relationships. Adaptability and flexibility in today's dynamic business environment. The topic is adaptability and flexibility. Oh, it's a little day. In today's dynamic business environment, organizations must be agile and adaptable to respond to changing market conditions, emerging trends, unforeseen challenges. Strategic financial planning enables an organization to anticipate and adapt to shifts in the economic landscape while staying focused on their long-term objectives. In summary, strategic financial planning is a vital process that guides organizations in effectively managing their finances, aligning resources with strategic goals, and building a foundation for long-term success and sustainability. So, how is strategic financial planning different from traditional financial planning? traditionally, when you are putting together a yearly financial plan or a budget, you are focusing on what's going on right now. A strategic financial plan also expands it into what could happen in the future. What do the trends make it appear like it's going to happen in the future? So it just depends upon your objective as to which you need to do right now. I do believe that all mission-based businesses all businesses, not just mission-based, should have a strategic financial plan in place, just like they should have a strategic plan. And what this allows them to do is give them ways to save. They can put money into investment account or even just a savings account until it builds up to the point where they can get an investment account. And it gives them a rainy day fund that will help in economic turmoil. So it helps with their sustainability. Strategic or just regular financial planning should be done every year by every organization. You should be creating a budget every year for your business. I don't care if you're a restaurant or a human services agency or a $600 million hospital. You should have a budget or a financial plan. So part 2 of today's training is key components of strategic financial planning. So what are the key components? The first one is goal setting. Establishing clear and specific long-term financial goals is essential in strategic financial planning. These objectives should be aligned with the organization's overall mission and vision. You should also have short-term milestones. By breaking down the long-term goals into achievable short-term milestones, it helps you track your progress, maintain momentums, and these milestones serves as checkpoints to assess the effectiveness of the financial strategy. We all know that having your staff focus on the long-term objective without giving them short-term wins is a motivation killer. Everybody needs to feel like they've had some wins on the way to reaching that final objective. So short-term milestones are important not only for planning and giving you time to pivot before there's an issue, but it also helps motivate those involved with the plan. 2, the second component would be environmental analysis. Evaluating the organization's internal financial strengths and weaknesses, including cash flow, profitability, and liquidity ratios, are going to help you know where you need to put some key focus on. So if you have cash flow problems in September, it helps you create a plan so that when you're cash heavy in July, you can put some of that money aside to get you through September. The second side of the environmental analysis is external assessment. Analyze external factors such as market trends, industry competition, regulatory changes, and economic conditions overall. Understanding the external environment enables proactive decision-making and risk management, which will then lead us into key component number 3, risk assessment and management. Identifying potential financial risks and uncertainties that could impact the organization's financial stability and performance. This is going to help because once you identify these risks, you can come up with a plan on how you can't really always avoid them, but you can get through them. Another thing is developing strategies to mitigate identified risks, such as diversification of revenue stream, hedging against market fluctuation, and establishing contingency plans. You've got to continuously monitor and reassess the risks to ensure that the financial strategy remains adaptive and responsive to changing conditions. I always talk about how a budget is a living, breathing document unless you are in the government. Your budget should always be something that you adjust weekly, daily, monthly, quarterly, whatever is in your comfort zone. It should always be looked at and adapted to the changing environment. A strategic financial plan is no different. So, component number 4, I think I'm on. Yes, 4 is resource allocation. So, allocating financial resources effectively through the development of comprehensive budgets that align with the strategic priorities. So earlier I explained the difference between strategic financial planning and regular financial planning. What I didn't go into was how regular financial planning is going to help your strategic financial plan succeed. Each year you should create a budget that's going to push you into that goal with your strategic financial plan. You need to evaluate investment opportunities and determine the allocation of capital to projects or initiatives that offer the highest return on investment and align with long-term objectives. Implementing measures to control costs and optimize operational efficiency without sacrificing quality or performance. You should always be looking for ways to control your costs of things, especially in an environment like today's where prices just keep going up. So component number 5, performance measurement and monitoring. We're going to start using some buzzwords now. Establishing relevant KPIs. I think that there should be some sort of game every time I go live. How many times do I bring up KPIs? That should let you know how important they are. For those of you that haven't watched any of my other videos, KPIs are key performance indicators, and they will measure the progress towards your financial goals and track the organization's overall financial health. KPIs are based on what you need them to be for what your goal is at the time. If you are trying to watch or increase customer engagement, then your KPIs would be how many likes, how many comments, how many reviews you've received in the period of time. Another part is implementing a system for regular financial reporting and analysis to provide insights into financial performance and facilitate informed decision making. This goes back to your living, breathing budget document. You should regularly be reviewing that and adjusting it as needed. Conducting variance analysis to compare actual financial results with budgeted expectations. Identifying discrepancy and taking corrective actions as necessary. These are all going to all of these are going to make it much easier for you to control your budget throughout the year. Because if you are, say your fiscal year is a calendar year. If you plan for something to happen in January for July, but by the time July comes, there's been changes. There's been many changes that you couldn't have forecasted in January. If you're not adjusting your budget to reflect those changes as they happen, come December, there's no way you're going to meet your budgeted goals, whether you're going to exceed your expenses or whether you're not going to meet your revenue goals, whatever it is. If you're not constantly watching it and adjusting it, you're just setting yourself up for problems. Number 6, strategic implementation. Developing action plans that outline specific steps and timelines for implementing the strategic financial plan. You need to align human, financial, and technological resources with strategic priorities to ensure effective execution. Fostering communication and collaboration across departments and stakeholders to gain buy-in and support for the financial strategy. Communication is key in everything you do. So by addressing these key components, organizations can develop a robust strategic financial plan that not only guides day-to-day financial decisions, but also positions them for long-term success and sustainability. Part 3, crafting your financial strategy. Crafting a financial strategy is a very crucial step in the process of strategic financial planning. Here's a detailed breakdown of how you can craft your financial strategy. Number 1, define your financial goals. You should start by clarifying your long-term financial objectives. Those could include increasing revenue, improving profitability, expanding operations, reducing debt, or building cash reserves. You just have to make sure that your goals are SMART goals. What does SMART goals mean? It's an acronym. It's specific, measurable, achievable, relevant, and time-bound. The reason why you want SMART goals is because they provide clarity and focus. Number 2, assess your current financial position. Conduct a thorough assessment of your current financial situation, including cash flow, income, expenses, assets, liabilities. Identify any financial strengths and weaknesses, as well as areas to improve or potential risks. Number 3, conduct a market and industry analysis. Analyze market trends, industry dynamics, and competitive landscape to understand external factors that may impact your financial strategy. Identify opportunities for growth and potential threats to your financial stability. Number 4, develop strategies to achieve your goals. Based on your financial goals and analysis, develop strategic strategies and action plans to achieve them. Consider factors such as revenue generation, cost control, pricing strategies, investment opportunities, and financing options. Number 5, allocate financial resources wisely. Determine how to allocate financial resources like capital funds, investments, cash accounts to support your strategic objectives. Prioritize investments based on their potential return on investment, or ROI, and align your long-term goals. Number 6, implement risk management measures. Identify potential financial risks and develop strategies to mitigate them. This may include diversifying revenue streams, securing insurance coverage, or establishing contingency funds. Regularly monitor and assess these risks to adjust your financial strategy as needed. Number 7, establish key performance indicators. Define measurable KPIs to track and progress the success of your financial strategy. Examples of KPIs include revenue growth rate, profit margins, return on investment, cash flow ratios, debt to equity ratios. It depends upon what your strategic plan is trying to accomplish. Number 8, review and update your financial strategy regularly. Financial markets and business environments are constantly evolving, so it's essential to review and update your financial strategy regularly. Monitor your progress against your goals, adjust your strategies as needed, and incorporate lessons learned from past performances. Number 9, communicate your financial strategy. Ensure that key stakeholders, including employees, investors, lenders, board members are all aware of and aligned with your financial strategy. Transparent communication fosters trust and support for your strategic initiatives. By following these steps and customizing your approach to fit your organization's unique needs and circumstances, you can craft a robust financial strategy that positions your business for long-term success and resilience. Okay, so now we've explained what strategic financial planning is. We've talked about what you would need to go about creating one. We've talked about how you create one. The next step would be implementing and monitoring your plan. Implementing and monitoring your financial plan are crucial steps to ensure its success and effectiveness over time. Here's a detailed breakdown of how to implement and monitor your plan. Number 1, establish clear responsibilities. Assign roles and responsibilities to team members involved in implementing and monitoring the financial plan. Clarify your expectations and ensure that everyone understands their respective dates and timelines. Number 2, I gotta get a drink, sorry. Develop an action plan. Break down your financial strategy into actionable steps and tasks. You should create a detailed action plan that outlines specific activities, milestones, deadlines for your implementation. Allocate resources appropriately. I hope you guys are starting to notice this theme. All of these are repetitive on how you monitor, create, and write your strategic plan. You need to allocate necessary financial, human, and technological resources to support the implementation of your plan. Ensure sufficient funding and manpower are available to execute the plan effectively. Number 4, communicate and align. Communicate the financial plan and its objectives clearly to all stakeholders, including employees, managers, investors, and board members. Ensure the alignment between the financial plan and other strategic initiatives within the organization. Number 5 is a no-brainer because we're talking about how to monitor and manage your strategic plan. Number 5 is monitor your progress. Regularly track and monitor your progress towards achieving the goals and objectives outlined in the financial plan. Use KPIs and benchmarks to measure progress and identify any areas that may require adjustment. Number 6, review financial performance. Review financial statements, reports, and performance metrics regularly to assess the financial health of the organization. Analyze variances between actual financial results and budgeted targets to identify trends and potential issues. Number 7, adjust as needed. Be flexible and willing to adjust your financial plan in response to changes in the business environment, market conditions, and internal factors. Modify strategies, reallocate resources, or revise goals as necessary to stay on track to adapt to evolving circumstances. Engaging stakeholders. Engaging stakeholders in the monitoring process by soliciting feedback, sharing updates, seeking input on potential changes or improvements. This is going to foster a collaborative environment where stakeholders feel empowered to contribute to the success of the financial plan. Number 10, which to me is one of the most important, celebrate your milestones and your successes. Celebrate milestones and successes achieved as a result of implementing the financial plan. Recognize and reward individuals and teams for their contributions to achieving financial goals and objectives. By following these steps and maintaining a proactive approach to implementation and monitoring, you can ensure that your financial plan remains relevant, responsive, and effective in driving the success of your organization over the long term. So, here are some takeaways from this very detailed process. The first one is clear communication and alignment. Effective implementation and monitoring of financial plan require communication and alignment among all stakeholders. Flexibility and adaptability. Flexibility and adaptability are essential when implementing and monitoring a strategic financial plan. Continuous evaluation and improvement. They are critical components of effective financial planning. Regular monitoring and regular monitoring of progress, analyzing your financial performance, and the review of the key metrics enable you to identify areas of strengths, pinpoint areas of improvement, and make informed decisions about adjustments to the plan. I hope you all take what you've learned today and implement it in your own business. If you don't have a team to support you with this, please comment support below and we will reach out to see how we can help. Take some time and ask any questions in the comments that you may have, and we will respond, or maybe somebody else watching these videos will see your comment and we'll have gone through something similar and can reach out to help.